All right. Well, let's get started. Well, we appreciate everyone joining us today. This is Matt Rinke of Illumination Wealth. We have the team here. We're all going to be contributing, and thank you for providing questions and submitting some things that we've been able to hopefully address during our Q&A. I know it's extraordinary times, and the things that we're experiencing right now have probably never been experienced by anybody to this, in this way, shape, or form. And, but we're here, and we're always here for all of you. And so I think as, truth tellers, there's always uncertainty, and we never know for sure exactly what is going to be happening. But part of our conversation is really going to be fact-based. But at the same time, I know you want to hear our thoughts about where things stand. And so we have our probabilities and educated guesses. But at the end of the day, with that uncertainty, we are here to help you prepare for whatever happens, whenever it happens. And part of being investors and doing planning is that there's going to be events that come out of left field, that cause the markets to go down multiple times in our lifetime, and we need to be prepared for them. And we're going to help make the best decisions around that. And so, despite some of the unusual activity out there, I think looking across the globe and looking at seeing what's happening is that, the areas of China that have been hit pretty hard, things are getting back to normal there. And so I think, we just need to be prepared and work our way through some of this mud in this period of time. And so, but we're going to answer some questions. And so as we go through this, I'll be passing the screen along to our colleagues and to share. And so one of the first things that we wanted to really address was just kind of understanding epidemics in the stock market and stock market history. And then who better to talk about that than our, senior investment strategist, Ben, who's been through many different market cycles. So passing the mic over to Ben, and Ben's going to share a little bit about market history.
Okay. Thanks, Matt. And good afternoon, everybody. Can you hear me?
Yep.
Yes.
Okay, great. Well, I love this graph for a couple of reasons. One, obviously, it's epidemics in the stock market, and it goes back to about 1970. I started my career in the business in 1972, which is pushing 50 years. So I've lived everything that you see here. We survived HIV/AIDS, the plague, the avian flu, dengue fever, MERS, Ebola, Zika, and so is the market. One of the things that was really interesting to me is if you look at the lower left-hand corner of that graph, around 1970, I think when I started, the Dow Jones Industrial Average was trading at about 700. I got registered, and the market went up for about 3 months, and we hit 1,000 for the first time, and that was sort of an incredible level. But when you look at it and then there's this sort of little hump there where it goes back down early in my career, and that 2-year period of 1973, 74 into 75 really felt awful at the time. Virtually every stock was going down, and it was difficult for a broker to make a living. But look at it on this bigger picture here, and it's insignificant. And as were these other things. The crash in 1987 was a spike, which led to a V-shaped bottom. I'll talk about that in a minute. There was the dot-com bubble. There was the financial panic, which everybody seems to remember. They're all a little different, but the one thing that is important if you look at this chart, I think, is the market always goes higher. It always recovers, always. And this time will not be any different. Sometimes it takes a little bit longer. Sometimes it feels a little worse than at other times. The abruptness of this one, I think, is a little bit shocking. So, but anyway, that's my story on that chart. The market has survived. I have survived all of these things personally. And with a few years behind us, this is going to look like nothing again. Have we hit the bottom? We don't know. Could the markets go lower? Sure. But if you look at this graph, which is sort of interesting, it's the bullish percentage. It's an attitudinal chart. And currently it's at 6%. I think, you know, anything under 20, 25% is pretty radical. So we're about as oversold as a market can get. The likelihood of it getting much lower than this, I think, is fairly remote. If you want to go on to the next one, Matt.
Yeah, absolutely.
So, again, the same question, have we hit the bottom? Could the markets go lower? These graphs depict some interesting types of bottoming formations in the market. 2018 is an interesting one because that's what we call a V-shaped recovery. It went down very, very abruptly, much like what we're experiencing today. And again, you can see the recovery was rapid and came back to the kind of levels where it had sold off from. That was also what we saw in 1987. You may have heard of the crash in 1987. That was a V-shaped market. It was, you know, in percentage terms, just a horrible, horrible sell-off. Started at the tail end of 1 week, and we had what we call Black Monday, where the market just fell off of a cliff. So that's your V-shaped bottom. 1974, that's the one that I lived early in my career. That one seemed to go on forever. In this case, you know, I would call it a double bottom. You'll see the earlier bottom in the middle of the chart, and then a second bottom, a test, if you will, on the right-hand side of the chart, and then upward and onward from there. The 1978 one in the bottom is the bottom of these three charts. It's kind of interesting. Those of us who are chartists or followers of technical analysis, without getting too esoteric in here, that's called a head and shoulders bottom. And you can see there's a left shoulder, a bottom, and then a right shoulder, and it's sort of symmetrical. Some people also call this maybe a saucer bottom, or I've heard it called a cup and handle. And if you can imagine that middle part being the bowl of the cup that you put your coffee in, and what you see on the right side is the handle. All of these are, you know, are recoveries from big sell-offs, and they're the more typical things. But what do they have in common? What they have in common is the market always goes higher afterwards. Always. There's no reason to think that this time is any different. Is the cause maybe a little different? Maybe. But probably with all of these markets, the one thing they have in common is they were all what I call priced for perfection before they started selling off. In other words, they were not looking for any kind of an exogenous event. And when it came, it was a surprise, and the surprise caused the market to sell off. And again, that's what you see right now. So my view is this is probably, this meaning this period of time over the last couple of weeks and the next couple of weeks, is probably going to prove to be a very attractive entry point for new money in the market. It's certainly going to be an unattractive time to sell, to panic out. When people start calling and saying, I can't stand it anymore, just get me out, that's, I guarantee you, it's going to be within days of the bottom. And we're starting to feel that a little bit now, although Matt would probably tell you there's been very few of those kinds of calls. This is a great market if you're a young person. Maybe not so great if you're my age, but it's a great market if you're young because you got time on your side. And as I said, markets will always go higher. And I believe in the American dream, and I believe in the United States, in our corporations, and we will get to this. So that's kind of the end of my story.
Yeah, no, thank you, Ben, for sharing. And I think, you know, some of what we've seen and looking back on a few charts just briefly is that October 2008 hit, you know, the most oversold levels that pretty much have ever been registered. But the market also went a little bit lower between October and March. So what we're experiencing now, it might not be the bottom, but as we look at how things do bottom, you're not going to know exactly when the bottom is. And so we just need to be smart about how we interact with the market going forward, and it being a more attractive entry point now than it has been perhaps in many years. And so what happens though psychologically is that bad news, there's likely going to be more bad news. The number of cases of the coronavirus is going up. The fact that we're talking about a recession and how bad business is going to be. We're in a recession already. They might not have announced it yet, but we're already in one just by talking to different clients and colleagues of ours. And so the fear, the bad news, the ability to continue to shock us is going to diminish. And so it's like, oh, the number of coronavirus cases is going up. Well, the market discounts that and it looks ahead, and it starts to feel as if, we've already heard that. We've already anticipated the worst because of how scared somebody gets. And so there's probably going to be a little bit more shocking news and headlines, but our reaction to them with the same shock in terms of market performance and declines, it's going to diminish. And so then I think that just takes us to, well, some of the questions that we got are, should we go to cash? And is now the time to go to cash? And we want to eliminate the cycle that is extremely unprofitable that happens with investing. And that is when things get bad, to be selling and panicking out. And when the coast is clear, to be buying. And what happens over time is that people repeat this behavioral pattern of buying high and then getting scared and selling low. And then the coast is clear and the coronavirus is gone. The market's already covered, then buying, and then something else shows up. We want to eliminate that pattern. And we know that, if we do make a decision to say go to cash, we now also have to be right on that decision, but also have to be right on when to get back in. And when the decision is made to go to cash, oftentimes people get biased about it's only going to get worse. It's going to get worse. It's going to get worse. And then we kind of knock ourselves off from ever being able to get back in, because there could be this chart below. The worst could be behind us, but we're still thinking it's going to get worse. And it might not ever get worse, and there might not ever be a better buying opportunity. And so we want to eliminate the cash addiction, knowing that we don't need to be all in or all out to succeed. And we don't know exactly where things are going to be and how long it's exactly going to take to recover. But we have history as our guidepost, and we're going to share with you a little bit about that in a little bit. But getting out now and going to cash now means that we're likely going to miss some of the market's best days. And oftentimes the best days in the market, the biggest returns on individual days, happen near the worst days in the market. You've seen the volatility as of late. And so what we want to be able to do is be market participants. And so the price for not being in on these best days that happen near market bottoms can be pretty costly. And what this chart is showing is, if we were to have $100,000 invested and stay fully invested, but we decide to get out and we miss some of the best days in the market, our returns over the long term are drastically reduced. So it's really about being in the market, having our time in the market, than trying to time the market for the best days and then missing the worst days. And so our balances and the portfolio balances would be significantly lower if we miss these best days. And that takes us back to a little bit of a sketched out chart, which is called the behavior gap. Now, the behavior gap is actually the investment return that the market produces and the investor's return. And what we see over time is that in the long term, the stock market generates 9–10% per year. The typical investor is generating a return of close to 4 or 5% over a year for the long term, because of their behavior, because of their buying high and selling low. And this is why we want to make sure that we invest systematically and not emotionally, because our planning process accounts for the fact that there are going to be declines and corrections and bear markets. If we're not planning for them, if we're not assuming that it's going to happen as part of our future, we would be doing our clients and ourselves a disservice, because we wouldn't know how to then react during periods like this. And so we want to not sell near lows, not sell off its highs, because this leads to really poor investment performance. But we understand how fear can cause people to sell and abandon a long-term plan at the wrong time. So we're very adamant about not going to cash at this stage of the market, which then leads us to another factor of our conversation that I want Norma to discuss, and that's regarding our clients' investment allocation. We've got questions around that as well. So, Norman?
Yeah, thanks, Matt. So I just wanted to reiterate what Matt just said, because I think it's very important. And that is that we have built and designed our client investment plans with the understanding that a market downturn could happen. So the fact that we're in this situation now, we prepared for that. We understand that this was a possibility. And so our investments are designed in a way to handle that. And so, one of the things we talk about when we're looking at our clients' long-term planning, right, is we talk about the probability of success in your plan, right? Will you be able to retire on time? Will you achieve financial independence? And these markets are factored into that plan. So that's kind of why you see your probability of success maybe not being 100%, but being 80% or 75%. And so that's just saying, hey, the market's not always going to cooperate. But should you be changing your asset allocation? And we would say, no, we don't want to change our asset allocation unless there are other factors that are changing in your lives, right? And so, for example, if you're going from working to retirement, well, we need to be evaluating your asset allocation during that time and potentially adjusting it based on, the forecast of your retirement plan, based on your own risk tolerance when it comes to investing. But we don't want to change our asset allocation because the stock market declined. Doing that leads to you having to make other changes in your plan. If we were to, at this point, sell stocks in your portfolio and make it more conservative, that's going to require you to either save more money from now until you achieve financial independence, or reduce your living expenses and reduce your lifestyle and financial independence. So it's important that we're able to weather these downturns, maintain our investment strategy, because it was designed to get you through this and to get you to your goal, whether that's retirement, financial independence, what have you.
Yeah, no, great. And I think one of the things psychologically is, for younger investors, we should be craving, bad markets. That it's a good thing, but also our reaction to risk is also against our own self-interest. If we're getting scared out of the market, it's going to impact our long-term plan. It might not feel like it in the moment, but it really does. And so I think that's really important. And so some other questions that we got regarding asset allocation was about just buying individual stocks. And so, I'll let Norman continue on with that conversation as well.
Yeah, so, this is a question that comes up quite often because, many people want to be investing in the right stock. Which stock is going to, have the highest return? But when you really look at your investments and what determines the performance of your investment portfolio, it's not which stock you pick, because stocks can run hot and cold. They're an individual stock selection that you make has a very small impact on your overall investment performance. And so this chart was a study done in 1991 that showed over 90% of your long-term investment returns came from decisions about how you allocated your money across stocks in the US, international stocks, bonds, real estate, etc., all the different asset classes. That was the bigger driver of performance, much bigger than which stock you chose, which was security selection, only a 5% determinant, or market timing. It was only a 2% determinant if you were able to time the market just right. So really it's about how your investments are allocated at a much higher level than just a single stock. One of the issues with investing in a single stock is that you can make the wrong choice. You have to be right on that particular stock. And there are many stocks out there that, people get excited about, and people get, there's a lot of news about them, but they don't last. The company doesn't last. The company may go bankrupt. There's so many things that could happen to an individual stock. This chart is showing you, the investment managers who spend their entire days looking at stocks and picking stocks to put together these investment funds. This is how they perform compared to the S&P 500 index. The S&P 500, again, is the largest 500 companies in the United States. And you can see the percentage of funds that underperformed the S&P 500, even in a 1-year period, more than half of them could not do as well as putting your money in the S&P 500. Over a 15-year period, which is what most of us are investing for long-term, over 90% of them could not beat the S&P 500. So all that to say that even the smartest investors out there, the people who do this day in, day out for a living, it's extremely hard for them to beat the market by choosing stocks. And so, in all of our investment strategy and our investment philosophy, we believe in index-based investing, where you're buying the entire S&P 500, right? So we don't need to choose the winners and losers.
Yeah, and I think the other point to add is that, not these companies, as Norman was saying, have CFAs and huge resources and are sending people traveling all over the globe to research companies. And at the end of the day, 9 out of 10 of them can't beat the market. And the 10 out of 100 or 9 or 8 out of 100 that do are not the same ones from year to year. So they don't persist. The big, smart money managers that are trying to pick stocks, there's not the persistence year in and year out. And so we think it's really important to just be mindful that having your allocation to the market and getting the market return with as efficiently as possible is making us better than pros, making your returns having the better to be than these huge hedge funds and huge mutual funds that can't even beat the market and underperform, and also often underperform quite drastically. So that's an important factor.
And then finally, around just individual stock buying, Warren Buffett said, hey, investing is simple, but it's not easy. There's so much that goes into making investment decisions. If you try to buy individual stocks, there's a lot of research you need to do. You need to understand the company that you're investing in. You need to understand their financials, their prospects. There's a lot of research that goes into it, so it takes time. Today you can sit in your bed and buy a stock on the phone, right? That's easy, that's simple, but picking the right ones is not easy. If you do think that you have a way of picking stocks, or you want to engage in that stock picking behavior, we would advise you to make sure you have a well-tested and systematic process in place for picking stocks. What are your requirements for owning a company? What are those things, that objective measures that say, yeah, that's a good company to buy? Not, hey, so-and-so said Tesla is going to skyrocket. We don't want to be buying based on what other people are saying and opinions. If you do think it's appropriate to buy an individual stock, we would recommend you make that no more than 10% of your portfolio. Because if a lot of your investment money, your hard-earned dollars, are in one particular stock, you could lose everything. It's possible. It is entirely possible that company could go bankrupt. you could lose everything. And are you okay with that? So we want to minimize the amount we put at risk in that situation.
Yeah, absolutely. So and why are we bringing this up, and why are clients asking? Well, we're getting clients asking us questions. Should we be buying individual stocks at this point? And some of our clients have their own accounts that they like to, that they might invest in the side in or test out some of their hypotheses or theories. We want there to be guardrails and this to be a professionalized process, not just gambling with money. We don't see the work that we do as gambling with our clients' money. We don't even want to gamble with your own money. So we want there to be guardrails around it, which means if we're going to buy individual stocks, it's going to be limited to a certain percentage of your overall portfolio or net worth. And we want you to professionalize it, because buying Amazon and having it go up, there might be a difference between being lucky or good. And so we want there to be a systematic process that our clients can learn from if they're going to venture into this process themselves, as opposed to, let me just throw something at the wall. So we want to learn and be pros about how we manage our money. And we want to encourage you, if you want to invest in your own, to make it professionalized as well. So that's responding to a client question. And then we also got a question from clients like, what about the real estate market? You know, what do we perceive or see going on there? We have many clients that are active in the real estate investment market. We have many clients that are active in terms of being real estate agents. So having a little bit of a pulse in terms of what's going on in the real estate market is also interesting. On the residential front, we're still seeing activity from within our clients who are exposed to the residential real estate industry, probably from buyers and sellers that have already been engaged over the past few months. But with the with the quarantine, being forced to stay home, it's very likely that prices are likely going to stall and activity is going to slow down. There's going to be sellers who don't want people coming into their house that they don't know, just due to this whole quarantine issue. And there's companies that are, restricting their agents from being able to go out and show homes. And so there's almost this forced wait and see mode. And so the real estate market, the residential real estate market, is likely going to slow down just due to this fact. But the other thing that deals with real estate is that it's very geographic. In San Diego, there's a very low supply of houses. And so it may not experience the same type of volatility that the stock market did, but having a stock market down might impact the way that people are feeling about purchasing homes because of seeing some of their wealth temporarily decline or the uncertainty in their business. You might have a multi-million-dollar business, a restaurant business that is now forced to close. That might change your purchasing decision. So it's very likely that residential prices are going to be slowing down and tapering off, and likely very little increase for the foreseeable future, just due to this wait and see mode. Investment wise, we have many clients that have private real estate as part of their investment portfolios. The benefit of that as part of the investment portfolio is that you don't see the volatility on the day-to-day, like you do on the day-to-day stock market. So it can provide a nice buffer, but it's only appropriate for people that have certain size and at a certain stage of wealth in their life. But on that real estate front, office and multifamily might be in a better position than other sectors, whether it's certain retail sectors of the economy, but they're not going to be immune. And over leveraged companies is where the big trouble will be. Many times people buy real estate and they take on too much debt. So there's going to be, certain sponsors that are going to have problems. But what's also interesting about this decline in this downturn right now is that in the past recessions, workforce housing, affordable housing, was often thought to be the most safest and stable because people always need a place to live. They always need a house to live in. Whereas Class A, the luxury rentals, the luxury condos, those had difficulty and didn't recover as fast in prior recessions. But what we're seeing right now is with this downturn is that the frontline workers, they're the ones being let go. They're the ones that are, the people that need the affordable housing are being the ones let go first. And so the workforce housing, the B, the C class buildings are likely to be more impacted, where the person who works for Apple or Facebook or Amazon or some of these other companies in service industries, they might still be able to be working remotely from home and doing their jobs wherever they are. And so there's a little bit of a dichotomy from prior downturns. And so the positives for real estate is that they're a slower moving asset. They don't have the same volatility that stocks do, which for the right clients we have, that's a big part of their potential portfolios. But they're not immune to economic declines. People might not be paying rent and going forward, and then they need to be negotiating. There might be rent abatement in order to keep their tenants happy. And so there's a cascading effect to this now, and we might be hearing about mortgage lenders providing some relief as well to different mortgage holders. And so I think the real estate market will likely follow, but not have the same level of volatility, but it's going to be sector by sector. So definitely need to be aware, but it's also going to provide good opportunities for the future, just like buying distressed stocks at a low. So the next thing we want to turn over, our CFP, Kathleen, she is pursuing her certified financial therapist designation. And times like this, they're uncertain. And so I wanted her to share a little bit about how do we deal with this uncertainty? And I know she has some great ideas. And Kat, take it away.
Yeah, thank you. Thank you, Matt. So yeah, I think during this time of uncertainty, of fear, of anxiety, it's really important to get in touch with what is going on with us internally, both from an emotional and a psychological standpoint. We're seeing, because of the fear, because of the anxiety, because of the uncertainty, what we're seeing is a lot of panic nowadays. We're seeing folks panic buying in the supermarkets, hoarding up all the tissue paper and the hand sanitizer and the food. We're seeing investors panic selling in the markets and moving to cash or moving their cash into safe haven assets. And so it's really easy to get caught up in that panic and feeling like, well, maybe I need to sell too, or maybe I need to hoard too. And what we know about panic, what psychologists have researched about panic, is that while it's normal to feel anxiety, it's normal to feel panicky, it's not really useful to us. It used to be useful to us back in the caveman days, where our ancestors were fighting dinosaurs and they literally were depending on this primal response of flight or fight to survive. In this day and age, we don't have, our life isn't endangered as it was during our caveman ancestors' days, but we still experience certain events that cause those flight or fight impulses to come up and make us react. And if we do end up reacting, oftentimes it can lead us to making bad decisions. And so if you're feeling a lot of anxiety right now, a few things that we encourage you to do is to, first and foremost, stay present. So not ruminating on what the media is reporting, not ruminating on what people are saying on social media, not ruminating on negative emotions, staying present, knowing that right now everything is okay, you're fine, you're good, hopefully you're healthy. And in keeping this mindset will help provide the mental edge that you'll need to capitalize on good opportunities as they present themselves. Second, have gratitude and appreciate what you do have right now. And third, identify what is causing your anxiety. What is the underlying cause of the anxiety and stress you're feeling right now? Is it fear of running out of money? Is it fear of not being able to save for retirement? Identify what that underlying fear is, and then reframe the situation, I think, is incredibly important. Using cognitive behavioral techniques to put a positive spin on what's going on. And so instead of, thinking, oh, the markets are tanking, the world is going to end, turn it around and say to yourself, yes, the market is experiencing a downturn, but this is an excellent opportunity for me to throw some excess cash I have to invest at significant discounts. Or this is a great time to front load my 401k contributions so I can be in a more favorable position when this market inevitably rebounds. Also, determining what you can control is also important. You know, at the end of the day, we can't control how the markets are moving. We can't control how long this coronavirus is going to last. The only thing we can control is our own actions and how we react to the events that are happening. And then understanding your why and what's important. Why are you investing in the first place? Is it for long-term goals, like Norman mentioned, financial independence and retirement? Keeping your eye on the prize, so to speak, and having that long-term perspective can really help prevent any adverse short-term reactions. And most of all, if you feel like you need help, don't be afraid to reach out and ask for help. If you have friends or family or a support system that you can reach out to, we highly recommend doing so. Or you can always reach out to us. Give us a call, shoot us an email. Any one of us are here to help you and to help hold your hand and get you through this weird time right now.
Awesome. Thank you, Kat. Fantastic. And I think one thing to lead with is that as investors, there is always uncertainty. There's times where it feels more uncertain, but every single day there's uncertainty in the financial markets. And we need to become comfortable with uncertainty, because going back to those first charts, there has always been something on the horizon that we didn't necessarily know about that day. And so, you know, to really spruce up on our investment behavior is becoming comfortable with this uncertainty. And so it leads us to some of our thoughts, because I know a lot of us ask, hey, what are you guys thinking right now? And I just wanted to share this quote about, it's not the head, but the stomach which determines your fate. And this is a really applicable to now. Peter Lynch was one of the most successful mutual fund managers. I met him when I was 12, and on my team won the stock market game back in the day, and had a picture in the paper with him. And so I think it's not our intellect, but our stomach. And if our stomach can't handle it, it causes us to make bad decisions. And so it's a big focal point of our conversation today. But we wanted to share with you a few charts which inform our thinking about what's happening right now and what we're doing. And so this chart, it shows the path of the stock market, the S&P 500, following a decline of 25%. The stock market has now declined 25%, maybe a little bit more from its highs that were just accomplished, you know, in February or January. And so there hasn't been a ton of different times where this has happened, but there's been 7 non-overlapping time periods going back to 1950. And if you can look at the chart, you know, we don't want to draw any major conclusions. 3 of the times after the 25% decline, the markets went down further. Twice, it got a lot worse over the next, you know, 3 or 6 months. One time, things got immediately better, dropped 25%, and it got a lot better. And then 3 other times it got better, but it took a while. So we need to be prepared for the fact that it might go a little bit lower, but in all of these instances, it actually recovered within a, you know, in the long term, within a relatively short period of time. And the average return after that 25% decline was pretty significant about 1 year later. So it just shows that the markets do recover, but there's not an exact playbook to what is going to happen today. We need to be prepared under any situation. And so what else informs our thinking? And the things that inform our thinking is that as long-term investors, when markets decline, it actually creates good investment opportunities. And so this chart basically shows the percent off the high. So if the stock market has now dropped 25%, what does this mean for future returns? And on average, the average annual future return. So if the market has dropped 25%, the average annual 20-year return from here is 9%. So you can see that as the market keeps dropping, those future returns, those future long-term returns continue to grow as well. So over the 3-year, and over the 5-year. So it shows that the bigger the decline, the better the future returns from there. So it's kind of counterintuitive, which is saying, hey, now is that time where instead of selling and going to cash, the odds of us making more money going forward are better here. So if we're at all going to change our allocation, it might mean to take advantage of the fact that future returns are likely going to be significantly higher than where they were several months ago. We just didn't know several months ago that this is going to happen. You just never know when those times are going to happen. But the returns are going to be better going forward than they were. So we need to understand that it could go lower, but it also means that going lower is going to only increase the returns over the long term for us as investors. So I think that's a pretty powerful chart. This is another way of showing it as well. These are the worst quarters on performance for the stock market going back to 1926. So there's some great depressions. The worst quarters were average 23% declines in one quarter. You can see 2002, you can see 2008, you can see 1987. But then you can see the ensuing forward performance from that period of time. The average 3-year performance was 38%. The average 5-year performance was 91%. So a decline of 23% requires a gain of about 30% to get back to even. That happens within the 3-year period of time, and then your 5-year returns are really even higher. A couple times during the Great Depression, it didn't recover, but it didn't recover right away within that 5-year period of time. But if you exclude that, all of the times have been positive returns over the next 3 and 5 years, and very significant ones after having really terrible quarters. So it's not about what happens over the next quarter for us as investors. It's happening what's over the next 3 and 5 and 10 and 15 years, because even if you are retired right now and you're 60 years old or 70 years old, your investment horizon is not 3 months. It's 20, 30, 40 years, which we need growth from that we can't have sitting in cash. And, from our own experience, we've spoken to people over the last 3, 5, 7 years that have been sitting in cash since 2008 and have never recovered and invested and benefited from the long-term growth because of that fear. That can't happen because it can only jeopardize the plan. And the real risk isn't these downs. The real risk is not getting the gains that come with getting the downs. The downs are the price of admission for these great long-term gains. So, how do we capitalize on things? How do we, manage this opportunistically? Part of what we're going to be doing is rebalancing our clients' portfolios along the way. If bonds, which have done very, very well, have become a higher part of the portfolio, we want to sell those bonds that are high, that really have low interest rates now, and buy stocks that have gotten low. That can add value and reduce risk over time. So we'll be rebalancing our portfolios. We'll be harvesting losses for tax purposes. This means we always continuously do this, but if there's a position that was purchased that's now at a loss, we will sell that to avoid gain or offset other income in the current year and in future years from that. And how else do we capitalize? If we go back to this chart and odds favor these being really good, a lot better investment times over the next 3 and 5 years, we want our clients to be accelerating their retirement plan contributions. Instead of having your 401ks being drawn out paycheck by paycheck over the next year, take advantage of this situation now with any future savings or retirement plan contributions. Do that intelligently. Speed those things up to get money working at these lower prices. We're also taking advantage of low interest rates where we can. I know the mortgage market is definitely being impacted by what's going on in the world as well, but we have numerous clients going through refinances, and that's an opportunity to be prepared to take advantage of changes in the interest rate market. And then other things that we're doing right now is for clients that, you may have the ability to fund tax-free accounts or fund Roth accounts or fund health savings accounts. We're able to shift taxable investments to these tax-free accounts to capitalize on all this future growth and generate that tax-free income, which is important. So there's lots of different ways to capitalize. The only way that we assure us that we won't is if we don't stick to our plan and if we sell. That is what we want to avoid, because that is detrimental. So being in a position to capitalize involves doing all of these things where appropriate for us. So I think I'm going to have Norman share a few other financial planning skills that we're talking to people about that I think is important.
Yeah, thanks, Matt. So Matt just talked to you about a lot of the investing ideas that we should be considering during this time, but there are other things going on outside of the investment accounts that we need to be considering. And some of these we've talked about with you before on in our meetings. And one of those things is having an emergency fund. You know, it's probably one of the first things we talk about. And you know, I just spoke with a client today who said, I'm so glad that we set up this emergency fund and I've got money available to weather this, because I believe my business, the income from my business is going to suffer. And so having that money set aside, it's never fun and sexy to have cash sitting in the bank until now. And so if you don't have that set up, let's make a plan to get that in place for you. If you don't have cash sitting in a savings account, is there backup funding that you have access to? Do you have a home equity line of credit? If not, let's get that set up. Your Roth IRA can act as a quasi-emergency fund. You can withdraw anything you've contributed to the account, tax and penalty free. Can't withdraw the earnings, but anything you have put into the account yourself over the last number of years, however many years, you can take out tax and penalty free. Zero interest rate credit card. Like, companies are always offering you know, introductory rates on a credit card. If there's a cash crunch and you don't have other sources of cash liquidity, this is an option. A business line of credit or personal line of credit. Those may, you know, help you get through this cash crunch that you may have if your business or the economy is you know, not holding up. Check in with your rental tenants. Are they okay? Are they going to be able to continue paying the rent? Have they lost their jobs? Let's get ahead of this rather than being surprised by a tenant who may not be able to pay their rent. Revisit your financial plan and investment policy statement. So we try to do this like a what if scenarios with all of our clients. What if the stock market drops? How are you going to feel? What do you think your reaction is going to be? And we come up with an investment allocation or risk scenario, but now we're really feeling it. This is the real thing. How do you feel now? Are you concerned? Are you thinking that your investment portfolio is not right for some reason? Are you uncomfortable with what you're seeing? If so, this is a good time for us to talk and revisit. Stay active, learn new skills, use this time to be productive. How can you, you know, make the most of time that maybe we're sitting at home rather than being at work? Identify counter-cyclical income streams. What other income streams might you have that, or might you create outside of your current income stream? If you're working part-time, is there another source of income you could be finding if your other source of income starts to dry up? Asking for help. You know, obviously we're here for you. We want you to reach out if you have any questions or need some help with something. Ask others for help too. Others may be able to help you as well. And then help others. You know, you may be in a good situation. You may not need help from others, but other people need help at this time. And how can we help our friends and family and other people we care about? So,
thank you. Great. So I'm going to turn it over just to talk about some of the things that are happening in the government with policy changes, just so we're aware of how that could impact us as people, as employees, as mortgage holders, as business owners. So Kat, you want to share a little bit about what's going on?
Yeah, for sure. So what's happening legislatively is Congress the House just passed the Families First Coronavirus Response Act, which is supposed to be a relief bill. And right now it's awaiting Senate passage. And what it entails is things like free coronavirus testing. So both private and public health insurers will be required to provide free coronavirus testing if this bill passes. And also those who don't have insurance can be tested for free. The bill also provides paid sick and family leave. So employees of companies with fewer than 500 employees will be allowed to take 2 weeks of paid sick leave and up to 3 months of paid family and medical leave, equal to no less than 2/3 of their pay. And so this benefit can be taken if an employee is either quarantined or is seeking preventative care. Also, small and mid-sized businesses would receive tax credits to pay for medical and family leave up to 100% of the wages if they pay out. And if a company has fewer than 500 employees, they will be required to provide 2 weeks of sick leave or full pay for employees who are seeking treatment for the coronavirus. If you are self-employed, you can also receive tax credits for paid leave under the bill. And workers would be eligible for paid sick leave if they have a child whose school or child care facility is closed due to the coronavirus. They also must receive no less than 2/3 of their regular pay. The bill also provides increased unemployment insurance. Now, I'm not certain whether the benefit is going to increase, but they are going to allocate more money to states to fund unemployment insurance if there's an increase in the number of unemployed people. There's also a change to the tax deadline, which has been pushed to July 15th. Now, there's been some ambiguity in the way that the media is reporting this. And so we want to provide some clarity on this here. So when Treasury Secretary Steven Mnuchin yesterday announced during his press conference that the deadline had been moved to July 15th, the deadline to file is still April 15th. That has not been changed. It's the deadline to pay any tax amounts owed. That has been pushed to July 15th. And so if you decide to delay it, you will not incur any interest or penalties by the IRS. Now, you can still file for an extension up until October 15 if you need to. And so we would recommend talking to your CPA in that case. But for everyone right now, the deadline to file is still April 15th. But the deadline to pay is July 15th. And so this will give you an extra 90 days to pay your income taxes due on up to $1 million in tax owed. And so this will be a reprieve for individuals and small businesses who might be struggling with cash flow right now. And then for corporate filers, you would get the same length of time to pay amounts due on up to $10 million. And then in addition to that, also yesterday, the Trump administration introduced a $1 trillion stimulus bill. This would, again, need to pass through both the House and the Senate, but the bill includes basically a stimulus package that would provide direct one-time cash payments to individuals. How much is going to be paid out is still up for debate. I've heard anything in the range of $1,000 to upwards of $5,000 per person. Senator Bernie Sanders has proposed $2,000 a month per person until the COVID-19 epidemic ends. So it's unclear yet how much folks are going to get. It's unclear if this is going to be means tested. There's just still a lot of unknowns. But the bottom line is that there are talks of folks receiving some type of financial relief from the federal government. And then last, as part of this bill, businesses would also receive financial support in the form of loans. And this would be mostly for small businesses and companies that are heavily impacted by COVID-19. So airline industry and other critical sectors.
Awesome, thank you. And another topic, we're going to pass it over to Andrew to share a little bit about what this means for health insurance. This is obviously a hot button item, and so what does what's happening now mean for health insurance?
Yeah, thanks, Matt. So whether you're enrolled in a group health plan that's sponsored by your employer, or if you're on Medicare, or if you're on an individual plan that's covered by your state's marketplace, the chances are that all of the testing for COVID-19 should be covered. I actually just received an email from my insurance carrier just yesterday mentioning how it's going to cover any co-pays, co-insurance, and deductibles as well. So anything related to COVID-19 is going to be covered, fortunately. And so some states have actually enacted emergency rules that have required your insurance carrier to cover any costs associated to it, without you having to come out of pocket for this. So I know a lot of our clients who may have a high deductible health plan could be wondering, does this jeopardize the status of the high deductible health plan? Because part of this plan is that you pay out of pocket up to your deductible, and then there may be a co-insurance till an out-of-pocket max, and then they fully cover any service beyond that. And so that actually, any COVID-19 related testing and treatment will be covered, and it won't jeopardize the high deductible health plan, which is great news. And so it also means that if you are on a high deductible health plan, it will cover these costs, and you will also be able to continue contributing to a health savings account.
Yeah, so insurance companies are doing their part to hopefully step up.
That's right. Yep. And then I know we have also a lot of small business owner clients as well. And so, there's really two big points of relief that are coming, and Kat kind of explained this a little bit in just the previous slide. But the biggest one is going to be there's legislation that allows employers a tax credit equal to 100% of any sick leave wage benefits that they've paid out. So it'll sort of offset the costs of that. And then the other item would be the loans that are becoming a lot more available. And through the Small Business Administration, they're offering, low interest rate loans to small businesses, any nonprofits that have been impacted by the COVID-19. I believe the interest rate for these loans is about 3.75% for if it's a corporation or a business, and then I think it's even lower in the 2% range for any nonprofits. So, the Federal Reserve has taken some measures to allow the loaning of money to become a little bit more easy for companies. So that is one of the other areas of potential relief for small businesses who are impacted in this time.
And so, thank you, Andrew. And so to piggyback off that, this is, there's going to be a lot of business owners that are going to be applying for this, whether it's the restaurant next door or the retail shop, that have been impacted. And so there's a website right here. You have to apply, and the application process is not extremely hard, but they're going to want disclosure of your assets and liabilities. The loan is personally guaranteed. Typically, as Andrew said, it would be a 3.75% loan over 30 years that you have to personally guarantee. If you have access, if you are requesting a loan that's less than $350,000, you do not need to provide that you already have access to other loans or liquidity. If you're requesting a loan above and beyond that, they want to see that they want to be essentially the lender of last resort in that case. And so if you have access to other loans, you're going to need to disclose that to them as part of the process. So how long is it going to take? We've heard things that they might require, they might want to try and get revolving lines of credit available even through this application process, because this is a fast moving thing. People need access to this now. And so if you or any of your friends are impacted by this, send them to this sba.gov website and have them apply. It's not extremely onerous. I tried to do a sample just myself to see what business owners are going to be experiencing, and it's not too difficult. You gotta register and then provide some financial information. So I think it's important, but also there's only right now there's only specific localities that have been approved. So these state governors need to get on that list. So I know San Diego is, and there's places in Northern California. So that, you know, if you're in some place that it hasn't worked out a thing with the SBA, you might not be able to apply it until you're on the list. That's part of the program. So I'm in San Diego County. So, you know, very important time, trying time for many people. But, you know, we want to remain flexible for our clients. We want to remain prepared, make the best decisions that we can, and do our best to always, you know, compartmentalize. Our life is intertwined with our careers and our businesses and our investment portfolios. And so on one hand of the coin, you know, we see this creating a really good investment opportunity, but at the same time, there's how do we make sure that our businesses and that we have the resources and financial means to, you know, pay our bills and get through this period, because we know that we will. And so, but we want to be here for you to help make those decisions and make those choices along the way. So if anyone has any questions, you know, feel free to reach out at any time. We appreciate you sending in your questions and thoughts. We're going to be here for you throughout all of this, and don't hesitate to reach out. So this has been recorded, so we'll be able to provide a recap, and feel free to share with anybody who may need some support. So thank you all. We appreciate your trust and your support, and are always here for you. Thank you.